going. I always like to say, you know, you failed to plan, you plan to fail, right? But we talk about, I used to do a lot of scuba diving, and the whole deal with scuba diving is obviously plan the dive the plan, and if you're a pilot, you got to file a flight plan. Even if you're floating down a river, you file a float plan. But we've got a good number of people on today, and we're going to talk about what's going on in the 1031 world, which is absolutely crazy right now. Going to talk about different options going forward. The biggest issue, you know, you got with any exchange, and we've got a lot of seasoned people on this presentation today, is that we've got time, and time's more critical than ever today. And we're going to talk about partial exchange. We're going to talk about other passive investments going forward. And I just want to sort of stress the fact that 1031 is not all or nothing. You're going to choose to defer what you choose to defer in the 1031. And you know, I have a client we're working with right now, and you know, he's got a substantial gain on a property, and he's trying to figure out, you know, what level it makes sense. And if we're talking about a property in this particular transaction where we've got, you know, maybe $800,000 in gain, and he's got a tax basis of, you know, maybe roughly around $600,000, and I'm just going to go through things and say, look, you know, if your ideal replacement property is a $700,000 replacement property, your basis on the relinquished is 6, you're going to defer the difference between the 6 and the 7 on this transaction, and you're going to have tax exposure on the difference between the 7 and the, you know, whatever the adjusted sales price is net of closing costs. So that would be a partial transaction. But I want to stress, you know, every dollar you spend more on something you want costs you a buck. If you don't spend it, you're going to look at whatever the tax rate is that you're looking at for that region of the country. And so it makes a big difference if you're in Texas or Florida or Washington, let's say, someplace with no state tax versus California where you've got a very high state tax. So you understand. The other thing I want to throw out there too, I was doing a presentation a couple of weeks ago with a good friend in the oil and gas world, Troy Eckert out of Houston. And we're just talking about, you know, the IRS, you know, going after people, and obviously in state tax, you know, in states where there's no state tax, you don't have the state coming after you. You've got the federal government on things if there's some issue there. But it makes a big difference when you're looking at a drop and swap or a swap and drop where we're changing ownership, and you know, looking at seasoning periods and those things. We'll talk a little bit more about that during the next hour. But once again, I apologize for the delayed start in this. First time I've given this presentation. If you've been on my calls before, you know that I speak quickly. I jokingly say that it's my job to give you guys a little nuggets of knowledge, give you an idea of what's possible, and also confuse you enough to the point where you know you need me. I also want to stress that we have a very robust portfolio of videos on YouTube. So a lot of the different topics that we're going to talk about today, we have videos on. If you want to know more about charitable remainder trust, for example, as an end game, we've got several big videos on that topic in there. If you want information on oil and gas, we've just recently completed some in that space too with Eckert. If you want to know stuff about DSTs, we've got several great series of videos on that. If you want information on opportunity zones, Connie Rathbone, you know, a regional lawyer that's done a lot of work in that space, we've got good information up there. So I would say, you know, my job today in this hour is to sort of get you guys to dip your toe in the water as to what's possible. And we are in a crazy market. So, you know, you got to think about 1031 sooner rather than later. If you ask me when I'd like to hear you or have you think about an exchange, I'd say when you're buying the asset, at worst, when you're contemplating a sale, and before you ever sell anything, I want you to talk to your tax people and understand what your tax liability is going to be. And back to my comment on that person with, you know, that $600,000 basis, without that information, without the knowledge of what your basis is, you really can't rationalize the exchange. So you got to understand what's there, what's possible, where you want to go with it, and don't just throw money at stuff. I mean, we're in a market where it's very hot. You know, are we at the top? I don't know. I've got lots of people in the institutional world, the DST space, talking 2 to 3 years that they sort of feel things are going to continue to go. I hope they're right. And if that's the case, we're just going to continue to roll along with it. And but then on the other hand, if you're looking at deferring a small amount of gain versus maybe paying some tax and having patient money, maybe today's the day you don't do the exchange. So you know, don't just shove yourself into a 1031 because you don't want to pay any tax, and meanwhile you're selling at top of the market, but you're buying something maybe paying more than you want. Really rationalize what you're doing, and you're going to do that by engaging your tax people and your investment people. Talk to your advisors, and we're just one person on that team of investment professionals for you. So we like to say you've worked hard for your money. We work hard to keep it yours. Title of today's presentation is the State of 1031 in 2022. We are in February of 2022. We are happy to be here. It looks like COVID is finally sort of lightening up, and we're going to be getting more back to life as normal, I hope. But it'll be interesting in the future, people looking back on some of these videos in this period of time and what's going on. So if you've got some questions, if you take a look at the right side of your screen, there's a chat box down there. If you've got questions, you can put the question in there if I've got time, or if it's something that I'm not covering, I'll try to address some of those as we go along. If not, we will be addressing any questions I don't get to during the next hour. After the fact, we'll get information back to you. This video will be available to you afterwards, as will the PowerPoint. So thank you for joining us today, and I hope you get some great information out of it. And I truly enjoy doing these things. If you've got ideas for a future presentation, or questions that you want answers to, reach out and we'll do our best to put videos together or presentations together to address those questions or concerns. It's really interesting. Yesterday, I was dealing with a client, or prospective client, I guess I should say, and he was he's a police officer out of Seattle. And he was confused because he's saying, look, I can't seem to get a black and white answer on some of this stuff. And I said, I started laughing. So, well, sir, number one, thank you for your service in that space. It's a tough job. And I said, you live at least the last couple of years in a world where you pretty much have black and white in there and what's right or wrong. In tax law, rarely is that the case. Good tax and legal people are going to be able to navigate through a lot of stuff that maybe you've been told you can't do historically. So, build that team of professionals, ask the questions, and as I always say, the only dumb question is the one you don't ask. So the last couple of years, and I'm going to go back. I was talking to a good friend this morning, and his father is actually, I blame him for my time in this business. But when we were getting this company put together in 1990, we put it together, ultimately hit the go button in 91. But he just says, you got to understand, every few years you're going to have to defend this code, and this code's now over 100 years old, but you're going to have to defend it. And Ron, I got to tell you, I'm tired of defending it. But at least we survived another round. So 1031's intact. We don't have any changes that we have to report. It's there, and I would say the last couple of years, part of our volume was based upon people trying to get where they want to go before any change might happen. But once again, I want to say we're safe at this point in time. If you want to stay on top of any potential changes, what's going on, take a look at the bottom of this page, that 1031buildsamerica.org. It's part of the Federation of Exchange Accommodators, but there's all kinds of great information on there. It's going to help you understand what 1031 actually does for the real estate world and for this country. So it's a wonderful thing. And Ron, I don't hold it against you. I've had a great time in this business for more than 30 years and met definitely a lot of wonderful people. Other issues I just want to talk about that we were worried about is the stepped up basis. So the old saying, swap till you drop, that was something that was going to go away. People used to say, well, gee, why not pay the tax bill? You're going to have to pay it at some point anyway. And that whole swap till you drop deal, the stepped up basis, has been preserved, and that was one of the things we were really watching. So In today's world, it still remains the case where you can exchange throughout your life. When you pass away, when you become an angel, your heirs are going to receive the property or properties with a stepped-up basis, current market value. They can turn around, relinquish those properties with no tax liability after that point. So that's still in place. Another issue that was really going to be devastating, at least to our business. We deal especially with, so we've got a sister company, IRA Advantage. If you're interested in using retirement money to go buy real estate or make loans, buy notes, buy things Wall Street doesn't sell, sign up for the presentation tomorrow. But we were in that business, we're always creating entities. Yeah, obviously in the 1031 space we do too, but with IRAs and 401k plans, we're doing C Corps, LLCs all the time for different investment vehicles. And we were really concerned because nobody holds real estate these days in S's or C Corps, just because you can't get out of that entity. If 2 or 3 of us have a property owned in an S or C, and we want to go different directions, just getting the property out of those things is going to trigger a problem, a tax consequence. Really, it would destroy any benefit of an exchange going forward. So that same treatment was going to be applied to limited liability companies, which would have just been devastating. So, I want to report that that did not happen. That's something we're very, very happy that has remained unchanged. As far as discounting is concerned, what I mean by discounting, we use discounting in gifting, and we also use discounting on the retirement side of our business on distributions. So what I mean by that is if you gift a minority interest, think about this. People quit claim deed properties back and forth to different people or entities all the time. But if we're looking at transferring a property from you to a kid, let's say, you just transferred the entire equity in that property. You've got to understand the gift tax laws. And in today's world, you've got a $15,000 per person per year. But if you're gifting a minority interest in something, that value can be discounted up to 40%. Now, this is once again another reason where you want good tax people and use these people before April 15th. Use them. Every time you're contemplating a sale, you want to understand what the tax liability is going to be. But if you're going to give a property or something to somebody, understand, talk to your tax people and plan for it. Understand what that tax liability is going to be. So gifting, it's commonly used, but it can also be used in distributions with retirement accounts. So we use it in that space. We have lots of people that will buy assets that they ultimately want to maybe convert into a property that they own personally. And so they'll take the property, instead of taking an entire property as a distribution, they'll take pieces of the property, minority interests. And usually if we're looking at, let's say, for example, a Checkbook Ira, the asset's owned by a limited liability company with a trust company as its member, and we slowly do an assignment of membership interest from the trust company to the taxpayer until the entire asset's owned by the taxpayer. So each of those transfers, each of those distributions are going to trigger tax exposure. And so we're looking at, one, evaluation of the asset, 2, can we discount those things? And the answer is yes, and that was preserved. So that was a big deal for us. Something that was very important, and I'm happy to report was unchanged. Capital gains tax, we had so much activity the last couple of years, and for the brokers on the call, this is the case. People were trying to beat any potential change in capital gains tax rates. Well, we're safe, at least for now. And if we look at what was going to happen, if you read the fine print, the thing that was really scary is the change in capital gains tax rates was actually retroactive to 4/26/21. So even if you had sold, can you imagine this? You sold a property and you thought, hey, gee, I beat it 4 years in before the tax law changes, and then they come back and hit you with the retroactivity on the increased capital gains tax rates. So once again, I want to stress this did not happen, and we appear to be at least safe at this point in time with the current tax rates. So this page just talks about different tax measures that had been proposed that we were very concerned about, and I think really were inflating or accelerating the real estate market in the last couple of years. Gain. Okay, so anybody on this call that went to business school, you had to understand some of this stuff in your core classes. But I remember in accounting, it's like, well, gain, left and right, what's going on with it? Gain has nothing to do with profit. Gain has nothing to do with net equity. I had a client yesterday talking about, well, gee, my debt on this, I don't really have, my net proceeds really aren't much because of debt on the property. Well, your gain has absolutely nothing to do with it. In fact, during recessionary times, you can lose a property. There's a slide later in the presentation talking about phantom gain. Gain simply the adjusted sales price minus the basis. Your basis is the purchase price plus capital improvements minus depreciation, but each of those things have an asterisk next to it. So, I mean, if we look at that basis, the purchase price, how did you get the property? Did you pull money out of your pocket to buy it? If you did, then that number's accurate, that purchase price. If you exchanged into it, you had a base carry forward. If you had maybe a lot of times people's first investment was their home. So, maybe pre-1997, you had the old 1034 rollover. Well, maybe it's 1033. 1033 is a involuntary conversion. That's base carry forward. You got a whole bunch of things. If it was gifted to you, your basis is what the person granting the gift was. If you inherit it, you got stepped up basis. So the purchase price can vary dramatically depending on how you got that property. Improvements. Every time I talk to somebody on this stuff, I say, okay, during the time you owned it, I know you put money into it. Did you do any capital improvements? Oh yeah, I did this, blah, 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 all these different things. I said, okay, did you write any of it off? Yeah, I wrote it all off. Okay, you expensed it, you didn't capitalize it. Capitalized items, you're gonna increase the basis, expense items don't. So once again, good tax people. Depreciation, what's the government's position on depreciation? Well, did you take depreciation over the last 10 years during the time you owned it? No, I didn't do that. Well, was it a rental property? Yes, it was. Well, okay, legally speaking, you should have taken it, therefore you did. So if you got audited, service is going to come and say, you know what? You should have taken depreciation. You didn't do it. You didn't get the benefit. We don't really care. We're going to come back on you with this depreciation recapture. So all these are reasons why anybody with income properties, if you've got much out there, you want good tax people because their job is to keep your money yours. And so often I hear people say, gee, they're so expensive, I don't want to spend that kind of money. And the reality of the situation is you can't afford not to spend the money. Good tax people are so critical in today's world. And you think about your year-end planning, my joke earlier about talking to them April 14th, you need to talk to them year's end. Maybe you've got gains on a property disposition, you've got maybe some losses elsewhere. Offset the gains with the losses. Understand what's there. Let them do their job and let them get into your life and figure this stuff out. But I just can't stress enough. Good tax people are just so critical to your investment success, especially over time. So, your adjusted sales price is just going to be the net after paying all those closing costs. Phantom gain. Phantom gain is one of those things, like I said, during recessionary times, we might have a property that lost to foreclosure or short sale. You think, well, gee, I lost money on that transaction. How can I have a tax consequence? Well, in a residential, an owner-occupied property, you've got some tax relief there, but on income properties, you don't. So if your basis is less than the debt on a property, you're going to have what's called phantom gain. The government's going to treat the debt as a sales price. So once again, I want to stress that whether you receive proceeds from a sale or not, it's really irrelevant with respect to the tax liability. So really think about that. That's why pulling money out via cash out refis at any point in time, you think about the actual equity in a property going away, it really has absolutely nothing to do with what your tax liability is. So I understand that. So if you sell, and I'm going to say, especially like I said earlier, in today's world, you want to know what the tax liability is because there's an opportunity cost there. The exchange, there's an opportunity cost to the exchange. The exchange is going to allow you to defer everything and get you where you want to go, keeping your money yours. And obviously it's my business to do that, and I believe in it, but the exchange is not always the right thing to do. An example I'll give you is, let's say you exchange, you want to go buy a property ultimately to be converted into your primary residence. So you do that transaction, you go buy a property at the beach, ultimately you want to move into it. You're going to need to hold that property as an investment for a period of time. There's a cost there. Where do you live during the time you're seasoning that property? So if you're deferring, let's say, $50,000 in tax, it might cost you more than that to live someplace else. So you've got to really rationalize your decisions. And as I said earlier, the best time to think about this stuff is when you're contemplating a sale, not when the sale is happening. And even after 100 years of existence, the number of calls I get, a day, 2 days, a week after a closing with somebody wanting to do an exchange is just mind-boggling. So really take the time, work with people that understand this stuff, and ask the questions. The only dumb questions one you don't ask. So what does it cost? Federal tax rates, typically we're looking, most of our taxpayers are going to be looking at a tax rate on appreciation at 20%. Depreciation is going to be recaptured at 25%. You're going to have state tax on top. In my state, I'm in the People's Republic of Portland. So we're looking at almost 11% these days. If you're in Washington, 0, like I said, Nevada, Texas, all those wonderful states, no state tax. You're just looking at the Fed rates. But also don't be surprised. We still have the old, the healthcare tax at 3.8. It's going to come in on some of you too. So understand that, and these are assuming it's a long-term hold on stuff, so a year or longer, and that it's been held for investment. So your next question is, well, I've been told I have to hold a property 2 years to have it qualify for 1031. That's not true. So we'll talk a little bit more about holding periods in a little bit. This slide just really talks about the fact that people are going to kick that ball down the road. They're not going to spend their whole life building, amassing wealth, using 1031 through the years, and then just pay tax at the end of the day. So part of the bullet points on this seminar was Endgames, and we're going to talk about different things to do at the end of the day. So you're not just going to keep your money rolling, deferring everything, and then just roll over at the end of the day, pay your tax. So we're at some point going to look at something else. Now, if you're on the call tomorrow, so when I look at an exchange, I look at 4 basic issues. It's got to be an exchange, which give and receive have to be of like kind. We've got to go across or up in value and equity. It's called the napkin test. And finally, we've got to have continuity of vesting. If we're looking at retirement accounts, I've got 2 issues that I have to deal with. What does the taxpayer want to buy? And who are they transacting between or for the benefit of? And when we're looking at these things, and one of the objections people have, the Wall Street world has, with respect to taking IRA 401k funds to go buy real estate, they say, well, gee, why would you do that? You lose long-term capital gains tax treatment by doing that. And that's true, you do, but there's nothing you're going to buy with those things that gives you long-term capital gains tax treatment. So, for those of you out there on this call, and you're thinking, well, I can do that. That's great. Surprise. It's a wonderful opportunity. For somebody that's been told you shouldn't do it because of that, well, that's not untrue, right? At the end of the day, if you pull money out of your pocket, go buy property. The great thing about 1031 is you get to choose to defer tax until at some point you choose to pay the tax. And the great thing is at the end of the day, if you've held things for more than a year and held it for investment, you're looking at long-term capital gains tax treatment, where anything in a retirement account is going to be taken out at some point. You're going to pay normal income tax on those things. So we're always looking at, our job at the Advantage companies is to keep your money yours. And whether we're talking about retirement accounts or in this case, today's presentation with tax money via 1031, we're the conduit out of what you don't want into what you do want. So we're going to look at where you are, and we want to know where you want to be in 2, 5, or 10 years, and we're going to help you get there. And that's the same situation on the retirement side. But you really want to work with a team of people. They're going to help you. They're going to work in harmony to help you get where you want to go. So, and as I said, no such thing as dumb question. Exchange fallacies. All right, these are things that really, after 30 plus years, I get tired of, but I sort of have fun dispelling it. Okay, so like kind does not mean house for house, land for land. And I always jokingly say that 30 years ago I had hair on my head, didn't have this sheen, this glow. I need somebody in makeup to take some of that away. But it's never been that way. It's nature of the investment rather than form. So you can go from a rental house into apartments, into office buildings, into land. All those things are going to be of like kind. Even certain elements of oil and gas are going to be that way. A 30-year leasehold interest in real property constitutes ownership of real property. So It's really wide open and it's never changed. So nature of the investment, not the form of the investment. 2, Section 1031 does not require a 2-year hold. Okay, I get told that all the time. Well, the code says 2 years. It does if I'm exchanging with my brother. Okay, so if I'm doing a related party transaction and I want to buy my brother's property, and we've got a page on related parties, so we're going to talk about that in a bit. But the bottom line is that if I'm doing an exchange with a related party, each of us has to do an exchange. Each of us has to hold our respective replacement properties for no less than 2 years. It's an arm's length transaction. There's no stated required hold. It's totally up to you and your tax counsel. It does not say 2 years, period. When we're talking about timelines, if you Google 5 years and 1031, you're probably going to have a whole bunch of stuff come up there too. That has to do with a property that's been acquired via 1031, converted into a primary residence. If you sell that property after converting it into a primary residence inside 5 years of acquisition, that transaction is going to be a fully taxable sale. So you got to be careful. Can you go out and buy a property, convert it to a primary residence? The answer is yes, but you can't do that conversion, move into the property and think, okay, gee, I'm going to live in it for 2 years, satisfy Section 121, sell it, take the exclusion, have no tax. There's something, number one, like I said, you got to hold it for no less than 5 years. Number two, there's something called the Housing Assistance Tax Act that's going to hit you pretty hard. So if you want to do that, give us a call. We'll go through that. All right. 3, there's no limit to the number of properties relinquished and or received. If you gave up a dozen properties, wanted to buy one, that's fine. If you give up one, you don't want to go buy a dozen, that's fine. The identification rules seem to imply that you are limited to maybe 3, but there's absolutely no limit to the number of properties you can relinquish and receive in an exchange. We're going to look at, we do a lot of transactions. If we're looking at aggregating of maybe we're doing a dozen relinquished properties, we're buying 2-3 different replacement properties, we might do what's called a blended transaction. We might buy some via reverse, and then maybe things sell, or maybe we're selling first, buying some via delayed exchange, and then those that have yet to sell will come in as a reverse exchange, or we're buying as reverse and then we're doing delayed after those properties sell. And that's where with reverse exchanges, whether we warehouse in a reverse exchange, the taxpayer can't be entitled to new and old properties at the same time. So those are issues that we come up with respect to whether we're doing a warehouse relinquished reverse exchange or a warehouse replacement reverse exchange. And that's another presentation that you have to sign on for. If you've got questions on reverse exchanges, once again, take a look at our YouTube channel. There's a pretty quick, concise 12-minute video on reverse exchanges, and we are doing a bunch of them right now. So definitely good information, and that'll hopefully clear up some of the fog if you've got questions on 1031. Another fallacy, you can carry a note and trust deed on a 1031. And I've got a client this morning I just had, before I got on this presentation, I had to go over with one of my coordinators, a seller carryback with one of our clients. So, there's literally 5 different ways to do it. We've got a slide that's going to talk about that, so I'm not going to talk about it anymore at this moment in time. Next one, 5, you do not have to replace debt in a 1031. Everybody, all the time I hear this. It's like, oh, I have to replace a debt in an exchange. No, you don't have to do that, all right? Debt can go away 2 ways. One, by going down in value, which triggers tax because you went down in value. The other way debt goes away is by adding cash. Now think about recessionary times. We've got a situation where typically we're going to see a reduced equity, and we're also going to see a reduced loan to value. You have to add cash. So I'll have people, and back to my comment, Ron, earlier, this is 30 plus years ago. We talked about, people being afraid of this topic, and it still is something that people are confused about. So we look at it, you can always add cash to a transaction. So you can offset mortgage boot with additional cash. You cannot offset cash boot with mortgage. So you can always put money into a deal without tax liability. You just can't take cash out and offset that cash boot with debt and have that okay. But once again, I want to say 1031 is not all or nothing, and that's that number 6 there. So I have literally had people ask the question, well, you know, my relinquished property was $1 million, and I'm $50,000 shy. Should I bump the purchase price by that 50? No, you're spending 50,000 too much. All right, so don't do that. You know, buy what you want to buy. Understand what the tax liability is going to be. Every dollar you spend over your basis represents tax-deferred gain, and be happy with that. But you know, really sharpen your pencil on those numbers and get yourself where you want to be on this stuff. And if you've got questions on it, give us a jingle. What are you selling? If I walk into a commercial brokerage and I start talking about Section 121, brokers are going to start rolling their eyes. You're going to say, gee, why do we care about 121? Well, if they've got an investor, if you're a commercial broker, you've got an investor that's got a whole bunch of commercial property with you, I'm going to bet, especially if they're on the West Coast or any place with high property values, they're going to have a home that has gains well beyond the 250 or 500. So if that person sells that home, they're going to have a huge tax hit. Well, why not help them out? Why not give them the opportunity to keep their money theirs? So, you know, Section 121, the sale of a primary residence, these rules came in 1997. And think about what was proposed with respect to 1031 with a $500,000 exclusion cap per person annually. And I think that $500,000 probably was proposed because of Section 121. That was a 1997 number. I would argue that the 250 or 500 from 1997 probably ought to be $1 million, $1.5 million today. So those numbers are woefully inadequate. So when people are selling their homes today, many are looking at a very steep tax consequence. So, you know, what's their choice? Pay the tax. Maybe we've got a number of you that are now working out of your home, and maybe you're treating that piece of your home as a home office. And if so, that piece of your home is no longer Section 121, it'd be 1031. So, you know, really look at what you've got and what you want it to be. So once again, our job is to keep your money yours, and we're going to look at these things and go over them with you, but we can only go over them with you if you give us a call. And it's amazing how few people just want to go back and forth on emails today. So 121 is primary residence, 1031 is income properties. I'm going to go back 30 plus years, and I'd say this number is still accurate. Actually, it's probably low these days. We've always said that up to 64% of the properties on the market could or should be exchanged. And now with the values where they are, I would say that number is probably even higher if we're really trying to keep people's money theirs. So once again, 121 gives an individual a $250,000 exclusion on gain on the sale of their home, $500,000 for a married couple. You can do that once every 2 years, and you have to have lived in the property for an aggregate of 2 out of the preceding 5 to qualify. It's not an elective proration. Now, during times of COVID, we might have people that had economic hardship, maybe they had health issues, maybe they've got some other thing that's happened. Maybe you can argue a proration of those numbers. That's going to be a discussion you have with your tax people. 1031 applies to investment properties. Now, can anybody out there think of a transaction that might contain both these codes? Well, an easy one would be a duplex, half owner occupied. Another one would be that home with a home office, like I said. Another one could be a bed and breakfast. So all these are examples. A lot of them are homes on acreage. What is the allocation on the home and what is the allocation on the acreage? Maybe you've got the house and a couple acres is the homestead portion, and the balance is investment. Now, if we look at the state of Oregon, they just passed a law, or it's coming into play in a few weeks or month or so, and it's going to allow larger lots to be broken up, put attached dwelling units on them, or just breaking them up. They want to increase density. So I would say we've got a lot of situations now where we're going to be seeing what was a single parcel now being broken into multiple, and it doesn't have to be a legal break here. We're just looking at allocations. You're just looking at a sale, and you're drawing a line on that sale, making an allocation investment and an allocation residence, and it's up to you to work with your tax people on those numbers and really massage them to make it advantageous, keeping your money yours, working both those codes. Things that might fall outside both these codes might be involuntary conversion. 1033 might be a situation on 121 where you didn't live in it long enough. It wasn't a hardship situation. Maybe it's dealer status stuff too. 1031 applies to property that's been held for investment. You're acquiring with intent to hold for investment. Dealer status, Clarkowski court case, 9 points that we typically use. I use those same points if we're looking at using IRAs and 401ks to buy property, whether we're conducting, making an investment or conducting business with that investment. So I use that case both on our IRA business, our IRA 401k business, and the 1031 space. I think is very applicable even after all these years. Questions considered. So anytime you're looking at this thing, you're looking to sell it. Is the property primary residence or investment? Are you going to invest the sale proceeds in other real estate? Do you know whether taxes are due on the sale of your property? Are you holding your property primarily resale? Dealer status stuff like I just mentioned. So you think about that. Anytime you think about selling a property, just ask yourself those 4 basic questions. I think it's really going to start clarifying what you're doing with this stuff. And really start looking at what you want to do, finding those things, those replacements. Everybody on this call that's done an exchange knows that time is the biggest headache with a 1031. And the second biggest issue in my mind is always going to be vesting, because those with the gold make the rules. And so often, that vesting gets to be a problem, whether we're talking about a partnership with a number of us buying things, or we're just talking about technically a partnership with spouses in a non-community property state. So that's how easily vesting gets to be complicated. So how long is long enough? This is a court case where 4 months was deemed long enough. All right. In this particular case, people exchanged out of a property, bought a new property with quote unquote intent to hold for investment. It was a rental house. The people bought it, documented their intent to rent, documented advertisements, documented showings. Ultimately, they moved into the property 4 months, got audited, taken to court, prevailed in court. Now, I think that's pushing a little bit, but hey, it's there, and I think it gives you sort of an idea of what they're looking at with this stuff. It's intent. It's not a black and white timeline. Get good tax people. You want them to support your decisions, and you want them to be working with you to rationalize and or justify what you have done if you were ever audited. Now, I like to say good tax people, they're my best friend. I want to build the case for an audit I hope never comes. And I certainly don't want to be the person in the line of fire on these things. So we want to make sure we're doing things as conservative as possible. If you're asking me how long I'd like to see you hold something, I'm going to tell you a year based upon a couple factors. One, it's been proposed several times, and 2, that's a break between short and long-term tax rates on assets held for investment. COVID and holding. Anybody on this call had a property and had a tenant told they didn't have to pay you? Meanwhile, what are you having to do with your debt service? So, COVID, this is just another example of, timelines and perceptions and people's misunderstandings on hold periods. If you've got a hardship situation, you do not have to hold these things forever. So what you don't want to do is start establishing a pattern. So we don't want to see repetitive stuff. Having bad luck once or having good luck once is one thing. Having it over and over again is quite another. So you want to make sure that what you're doing is going to be agreed to by your tax people. If we buy something and we get an offer that's too good to pass up, a month after acquisition, and it was an unsolicited offer, could you do that deal? And I'm going to tell you yes. Let's say you do another exchange, buy the next property, and the same thing happens again. Now you're going to start having problems. The same thing if you're doing it for hardship. You do it once. The old saying with pigs and hogs: don't cause yourself a problem. Be real. Use your tax and legal people. Work with them and do the right thing. So, but if you've got a property And I tell the story of somebody that buys something just pre-COVID, and all of a sudden, boom, the tenants stop paying. Now they're in a situation where everybody thinks real estate owners are so wealthy. Well, in my experience, they're cash, cash poor, land rich, and you just got to look at that and understand we all got to get through it and use those tax people to take care of your situation. 4 cornerstones: got to be an exchange. Items relinquished received must be of like kind. Got to satisfy that napkin test to cross or up in value and equity. And then finally, continuity of vesting. So, that's simple, right? I like the old KISS principle. A buddy of mine, J.C. Kutnikoff, this was early 90s. He had worked in the restaurant business, opened a whole bunch of restaurants for a Canadian company, got tired of it after he got married, and he said, hey, I'll help you, work the biz for a while. So he came and worked it, and he always, just like the KISS principle, and I do too. So I always break it down, these 4 basic elements. Don't make it more complicated than it's got to be. So next few pages talk about this exchange diagram. I'm not going to talk about it other than the fact the taxpayer is the exchanger. They're up top, we're in the middle. They give us something, we sell it, they tell us what to buy, we buy it, we give it back to them. Those arrows are the movements of ownership through us. The deeds are actually going directly between the exchanger and the buyer, and the seller and the exchanger, unless we're doing a reverse or an improvement exchange. Phase 1 of the exchange is what's being relinquished. Phase 2 is what's being acquired. The timeline is the biggest issue with the 1031. The 45 and 180, they start simultaneously at settlement. You are not allowed elective extensions, all right? It's got to be, the only extensions we are allowed, it must be presidentially declared, national disasters. So, if we look at it, typically we have, depending on the region of the country, we usually have hurricanes or tornadoes someplace. We've had fires that did it. We had a COVID extension that was really not very satisfactory, but it was there. So if we get notices that there's extensions being issued for a region, we're going to send it out on our newsletter. If you want to be part of our newsletter, please reach out to C-Moore, C-M-O-O-R-E, at 1031exchange.com. It should get you on the list. You'll be getting notices on that stuff. If you're working with us in a transaction, you're going to get notified if there's an extension that's that we perceive impacts your transaction, and you got to be able to document that it impacts your transaction. But that 45, 180 both start simultaneously. I want to stress that it's 180 days or the due date of the tax return. So make sure that if you're doing an exchange late in the year, you file an extension so that you can complete the exchange pre-filing your tax return. Property ID, 3 different identification rules, each works independently. And I'm sort of, like I said, I'm racing through the section. I want to get the examples in the end games. I think they're very important, and I think you'll appreciate it. But the ID rules, you got 3 different rules. Each is independent of the others. 3 properties of any value, pretty self-explanatory. I guess I want to stress, everybody assumes that the accommodator has to get the ID. It's got to go to somebody that's part of the transaction without an agency relationship. So, who could that be? It could be us. Could be maybe the seller. Could be the seller's broker. It couldn't be your broker if you're the exchanger. Cannot, anybody that's got an agency relationship with you, if you're the exchanger, cannot be that person. Could be escrow. So I'm going to encourage you to get it to us, and we're going to send out an ID form after we have the final settlement statement on the relinquished property. And that ID form is going to give you the 45th, 180th days. It's going to give you ID rules, and it's going to give you a form to fill out and get it back to us. So you got 3 property rule, 200% rule. You can ID more than 3. Total value of the property's ID can't exceed 200% of the relinquished property's value. You can exceed 3, you can exceed 200%. You got to close 95% the aggregate value of all properties identified. That 3rd rule is brutal because you're literally having to close everything you've identified. If I'm a broker, I know some great brokers. I don't know anybody that really wants to tackle that one. And by the way, you can change your mind on that ID anytime up until midnight the 45th day. It's satisfactory identification. You've got to give what the government would deem an unambiguous description. You have to receive substantially the same thing. So if the ID Now, let's say you're buying into a DST. Don't identify the entire DST. You want to ID the portion that you intend to buy. If you're buying with 2 or 3 other buddies, you need to identify that portion. If you're buying more than 50% of it and you ID the whole thing, you should be fine. But if you're picking up 20% of it, you ID the whole thing, you're not getting substantially the same thing. If somebody wants to make a problem for you, you're going to have an issue there. This slide is critical, all right, because we're in a market, everything's moving fast, things go away. And one last comment on identification, and this always cracks me up, because if I go back to, let's say, 1991, we're looking at an audit manual, and one of the questions in the audit manual was, was the property listed at the time of identification? Well, that's a ridiculous statement, ridiculous question, because does a property have to be marketed or listed for sale to be identified or to be acquired? And the answer obviously is no. So it's totally irrelevant whether the property is on the market or not, or furthermore, if the property's been sold. And that's the issue I want to get at. So if you say, well, which gets me to the slide, when can you get your money? If you ID properties on our ID form, we've got lines on there that says, okay, you're identifying boom, 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 these, let's say 3 properties or 4 properties, whatever it might be. But then the next paragraph says, but I have the right to buy blank of these. The reason it's on there, the reason that blank is there, is because in today's world, if you identify, let's say 3 or 4 properties and you only have the intent of buying one, as soon as you've purchased the one, after we're outside the 45 days, you're in compliance with 1031 G6, we can give you your money. If you don't put one in that blank, you've identified 3, even though you only intended to buy one, you've still got 2 more, and you might say, well, gee, they were sold, I can't buy them anymore, it doesn't matter. Or worst case, let's say that all 3 go away, and now you can't complete the exchange, we can't give you the money. And you say, well, I want to shift gears, I'm going to use an opportunity zone, an OZ as a fallback. Well, an OZ's got a 180-day timeline. So you're stuck. Now, if you want to go into an OZ, well, maybe if I can't release the money to you, maybe you've got money elsewhere that would represent your exchange proceeds, and I would say shove it into that transaction that way, and you'd be okay. The same thing applies if you're working, maybe you're a foreign investor, or maybe you're a broker on this call and you're working with a foreign investor, that FIRPTA rule. Okay, so the Foreign Investment Real Property Tax Act requires an impound at closing. And it's honestly the buyer's on the hook for this thing. So what happens in a lot of those transactions, the money gets impounded, and anything with the federal government's slow. And so a lot of times that release of funds doesn't happen until after the exchange is the 180 days happen, we can't do anything with it. So typically what happens with FIRPTA is our client comes out of pocket the money that represents the exchange impound, and then we can complete the transaction. When the release of funds from FIRPTA happens, then they are made whole once again. The same thing with the OZ. If you've got money in the exchange and you can't get it from the exchange company because they're in compliance with 1031 G6, nobody in the exchange world is going to work outside of 1031 G6 if it's a professional company that knows what they're doing. 1031 G6 basically says you as an exchanger are only able to get money after you've purchased everything you have the right to buy. So that means that after the exchange company gets the money, you cannot get the money for any reason inside the 45 days. After the 45th day, you can only get the money after you've purchased everything you have the right to buy. So the problem is, and you're saying, well, who cares? I'm going to pay the tax anyway, right? And I understand that thought. The problem is there was a ruling that came down, basically says, look, we understand your exchange is invalidated by your receipt of the funds, but if the exchange company goes along with it for you, the policies and procedures of the exchange company are invalid. Therefore, any exchange done using the same policies and procedures are invalidated, and every transaction is valid. So, as I said, nobody in the exchange world that does this professionally is going to give you money outside of 1031 G6. There's an old saying, accommodating accommodators. You don't want, you might think it's a good thing, but it's not. You got to follow the rules. You got to be working with companies that are following the rules. Otherwise, the validity of the transaction itself is vulnerable. Related party transactions. You can sell to a related party. You cannot buy from a related party, with the exception of both of you doing exchanges and both of you holding your respective replacement properties for no less than 2 years. The fine print says that 2-year hold wouldn't apply if you can document there was no intent to avoid tax. So when you're looking at this topic, talk to your tax people, work it out, make sure that both you and your related party are going to satisfy this and be in agreement with what's going on. So who is a related party? So we're going to talk about lineal ascendants, descendants, their spouses or any legal entity own a controlling interest in one of those. Now, when we're looking about retirement accounts, we have the issues. Like I said, we've got 2 issues. What are you buying? Who are you transacting between or for the benefit? The funny thing is with retirement accounts, we have a trend. You can transact along with a related party. You can't transact between or for the benefit of one. So I just want to put that out there clearly. But the funny thing about the retirement accounts is that you can work with a brother, siblings are okay, aunts, uncles, cousins okay. Where in the 1031 world, siblings obviously are not going to be something that would be falling outside of the related party rules. Notes in exchange. These are the 5 options. Sell the note to a third party. I don't know why the discounts are so big, but they just are right now. When you put money in the bank, what do you get on it, right? So obviously there's benefit to a note and trust deed sale, but if you're trying to sell that note, discounts are pretty high. So that's an option to do these things. When the property closes, the note's going to come to the exchange company, and we're going to be the Benny of it, and then we're going to use that note somehow to go forward. We're going to sell it to a third party. Most of the time, this number 3 is what happens. Most of the time, our taxpayer buys a note from us. And you say, well, why would I buy my own note? You're really doing is substituting cash for the note. I've actually had people borrow money from a bank to buy the note. And you think it costs a capital from a bank these days, you think about what you're going to get on a seller carryback. If you got money sitting in the bank, you're making nothing on it. Let's say you sold to somebody in a cannabis space, you might get 19% on the money, right? So, those things are very attractive, and it's a great end game for you. Short-term note maturing before acquisition. Maybe the buyer's financing fell apart. Maybe they just, worked the deal out. Maybe they're 180 days coming in. So maybe it's a situation where it's just an accommodation to the buyer to get the deal done, or maybe the property's not financeable as it currently is. So you do a short-term seller carryback. Once again, the exchange company's got the note. As soon as the note balloons, boom, now you've got the cash to complete the transaction. So that one happens a lot. Number 3 is what typically happens. Number 4 happens a lot. We've got a deal we're working on this morning that is using number 4. And number 5 is you do a partial exchange. You pay tax on the note as payments, principal payments come in, and then maybe you're deferring the gain if it's enough of a down payment to do any of that. Maybe we're doing the work with the cash and paying tax on the installment sale. Now, words of caution: seller finance. You've got tax exposure on debt relief and depreciation recapture of the year of sale. You're also going to have some closing costs, so make sure that you're getting enough of a down payment to cover all the closing costs, the tax obligation on debt relief, and the tax obligation on depreciation recapture, or you're probably going to be a very upset person when you walk out escrow having to write checks to different people. So once again, your tax people need to be involved, understand what the liability is going to be when you're looking at these things. But if you have to seller carry, or you want to, it's possible, and there's 5 ways that are there to do that. Some options here, then we've got a couple examples, and we'll get you out of here. And I know we're running, actually we're doing okay. I must be speaking very, very quickly this morning. So swap take drop, we talked about it, safe for now, and it's always a golden one, and it's something that people are always talking about, and use it while it's here, right? Use it or lose it. 1031 into a retirement home. That one's used a lot these days. So you've got a pure income property and you want to retire at the beach. What are you going to do? You're going to go buy that property. You're going to hold it, let's say, for a year or so. Then you're going to move into it. Do not sell it within 5 years of acquisition. It's going to be a fully taxable sale. Even after the 5 years, you're going to be subject to something called the Housing Assistance Tax Act. So if you think you're the clever one that's decided, hey, I'm going to buy the property, hold it a year, move into it, live in it 2 years, sell it after 3 years, take the exclusion, get rid of all the gain, that does not work. No longer works. It used to work in the late 90s. It worked, but it does not work. And understand that. So if you want to do that, you want to exchange in a retirement home and you plan to live in that property for the foreseeable future, great. If you think you're just going to do it and get rid of the tax using Section 121 in the future, don't do it. It's not going to work. Installment sales, we just talked about how to deal with those. Hey, if you want out of real estate, you just want income over time, installment sales can be great. Obviously, you want to make sure you're getting enough of a down payment to take care of all those costs that we talked about. And if you're looking at it as income stream over time, you better have some teeth in that thing. What I mean by you better have some prepayment penalties in place. One of the things I love about known trustees, for example, is, let's say, and I've got a buddy that's, talking about selling a business in a building right now. He bought it on a seller carryback. That guy's been very happy with the income stream over time. He was looking at it as a retirement. So, I suggested the great thing about known trustee is you can do a substitution of collateral. So that guy could, in effect, decide not to be paid off on disposition, and there'd be a substitution of collateral from the current asset to our client's new asset. And maybe you shove that note onto some other piece of property in the interim if the person does not want to have it totally uncollateralized for a period of time. Structured sale. What's a structured sale? Structured sale evolved out of structured settlements, and really it's an institutionalized installment sale. So the tax treatment's going to work just like an installment sale would, but the obligation to pay gets shifted to a third-party assignment company that assumes all the obligation to pay, and you can literally structure this sale to be over months or years. I mean, you pick the term that you want to be paid out. And so, if you're working a transaction and say, hey, I made a lot of money this year, I don't want to have the transaction close this year, but I really don't want to lose the buyer, I don't want to lose this market. Well, you could have a structured sale set up and you could elect to have the payoff next year, or it could be 10 years from now. But they're out there. It's something that's very powerful. An UPREIT. An UPREIT's another great option for somebody. It's also references a Section 721 rollover. In a nutshell, you're buying an asset that's going to be absorbed by a REIT, and ultimately you end up with shares of that REIT. And I would say it's sort of the ultimate installment sale, because then every time you sell a share of the REIT, you pay the tax on the gain on that share. So, I mean, you literally pick when you want to pay the tax at any point in time. And I just think that's very nice option. And I know that even some of our institutional real estate partners in the DST space, Inland Private Capital and Cantor Fitzgerald, I believe both of them have put some UPREIT options together recently. I'll just warn you, anything in that space is very, very, very quickly fully subscribed. So make sure you're working with brokers, and if you're buying into that stuff, it's a securities broker. It's not going to be a real estate broker that's selling it, but make sure you're working with people that are on top of that and that have some pull in that space, so that they're going to have product for you. Deferred sales trust, the other DST. So all these acronyms, right? But that's sort of another form of an installment sale. And I guess the one thing with that is, make sure that your tax people are okay with it, because that's something that the federal government is not given a formal okay with. They seem to get more popular, but that thing is out there. It's something that people talk about. You can Google it and find out more on deferred sales trust. They're there. Charitable remainder trust, you got a charity, you want to give a property, you want to have some tax benefit, you want some income over time. Excuse me, CRTs are a great option for you. If you want more information on them, Google Equity Advantage, Charitable Remainder Trust. Tina Colson in my office worked in that space for a decade, and she and her former boss put together a very nice series of information videos on the Charitable Remainder Trust. I think you'd find it very helpful. DSTs, okay, DST, everybody, all my buddies in that space right now, they're just so busy, all right? So many people, I'd say refugees from a lot of the blue states. I mean, any state that has huge tenant rights, people are just tired of it. They can't afford to hold the properties. They can't afford to maintain the properties. They can't afford the liability of taking care of stuff. I've got a good buddy that's a broker that told me the story a couple of weeks ago. And this is a guy that knows what he's doing. He had tenancy that were a problem. He finally got them out. Of course, it's in Multnomah County in Portland. And right after they got them out, he had some people bust down the door, move in, and he can't get them out. I mean, it's just horrible. So, bad situation. So we got lots of people that are just going, say, I'm done with it. I don't want to pay the tax. Delaware statutory trusts are great. Great option for people. Typically, a DST is a multi-asset option. You're not typically looking at DST as a single property. It's going to be multiple. You pick the food group you want to buy into. I mean that. You want mini storage, do that. You want apartments, you do that. You know, whatever type of thing you want, you can do it. Now, if it's a multi-asset offering, you want to make sure that you understand what that means for you and your tax people work-wise going forward. Most of the big guys in that space are going to package up, if it's, let's say a dozen properties, they're going to put it in a single state, so you have one return instead of 12 different states and 12 returns. So just understand those things are there. And as I said, when you're identifying that portion of it. Understand DSTs are typically stabilized assets. So you're going to get a check in the mail, maybe the returns. It's not going to be as good as if you go out and buy something personally and work on it with all your energy and your time. But you don't have, you're getting a check in the mail. So they're a wonderful option. We've got lots of people that historically really were hands-on people, and with everything in today's world, they just said, I'm tired, I'm done. And they're going into that. And like I said, it's a stabilized asset. You're going to get a check in the mail, and any pop at the end is going to be based upon appreciation of the asset over time. So obviously, the other side of an institutional DST would be institutional tenancy in common. And the institutional ticks that are out there these days are typically value add plays. And what I mean by that is they're buying assets, they're going to give you a check, but ultimately your return is going to be based upon what they do with the asset. And I grew up, I was taught never to bank on appreciation, that you're going to make this asset work. So BC properties and making them better, right? So typically institutional TIC is going to buy something that's maybe underachieving and make it work better, and that you're looking at a single asset. And those companies are out there, and a few of them out there doing a great job right now. And obviously there's a need for those. Oil and gas, we've got, as I mentioned earlier, we've got people that are going into that. They want to diversify into something else. Diversification, you talk to any financial advisor, they're going to tell you the secret to success is diversification. So oil and gas is just another place to diversify. If it's the right offering, just like if you're looking at IRAs and 401k plans and buying precious metals, it's got to be something that's structured for that application. But there are oil and gas offerings that fit 1031. So make sure if you're looking at that space that you're talking with a company that provides it for 1031 application. And it's a great way to diversify and maybe look at something outside of a traditional hard asset. And like I said, if it's structured correctly, it is like kind, it is real property. So it's a great option for you. The gifting is an end game. As I said, it's always there, gifting things from one gen to the next. You got to look at where you are, look at your net worth, look at the estate taxes, look at what you're trying to do. If you got kids, where you're going, and understanding those discounting options are out there on helping moving assets from one place to another. Exchange until it makes tax sense. What I mean by that? Well, just we don't see rates go down very often, but they certainly go up. But maybe you made a pile of money this year and you're not making it next year, or maybe you've got losses one place that can offset gains in another. That's what I mean by exchange until it makes tax sense. So back to that critical person in your life, that tax counsel, use those people, ask them the questions before you have a closing so you can plan and work and offset. If you got gains on the property, maybe you have losses elsewhere, maybe you do a partial exchange. And then one thing I didn't hit on that, when can I get my money? And I'm sorry, I'm going to backpedal a little bit. So if you want to pull money out of an exchange, you want to do a partial exchange, you can pull money out at close or after you've purchased everything you have the right to buy. So if you know you're going to do a partial exchange, you want to pull the money out at close. If you're working with Equity Advantage, in our assignment agreement, paragraph 8 asks whether you'd like to retain any taxable proceeds. If so, how much? So if you want to pull money out of the transaction, you want to do it at close, you're going to write in there, okay, I want to pull 100K out, put 100K in that blank in paragraph 8, section 8, and you're going to walk out. That specifically excludes that money from the exchange. If you do not do that, if you just say, hey, I want to pull 100K out, and it's not specifically excluded from the exchange, you could have a problem with the transaction. So it's really important that if you're walking out of that closing with money that's set up right and it's documented correctly so it's defendable. And that's what we've done. That's why, one, like I said, on the ID form, we've got the lines where you're identifying what you want to buy, but we put that blank in there with the number of properties you want to buy or plan to buy. And then when you're pulling money out, it's going to be the same situation. You want to pull money out of that close, you've got to stipulate what it is that you're pulling out, and it's specifically excluded from the exchange, and you have the right to that money at close, and you don't have to wait until you've purchased everything else to get that money. So if you know what you want to pull out and you want to pull it out close, great, put it in that section 8 in the assignment agreement, and you're going to walk out escrow with that money. The other thing we're doing, like I said, partial exchange is more frequent. Smaller transactions are also happening. A few examples, and we're done here. If you've been on these before, I use a lot of these. This is just an example of a property. This originally started with these clients coming to us as a residential sale, and their lawyers said, hey, why don't you go talk to Equity Advantage and see what they can do for you. They were looking at over $1 million tax hit. And so what we did is, it was their home they were selling. We told them to move out of the home. They moved out, seasoned it as an investment, went out and bought a new home, and the property was held. Now, let me ask you this, and obviously I'm not looking for an answer, but does the property have to be rented to be considered held for investment? And it does not. So in this case, they moved out, held it for investment. When it did close later, they still fit. You can move out of a property, and that universe exclusion at 121 still says 2 out of 5, so you can move out of it as long as you sell it within 3 years of moving out. It still fits the 2 out of 5. So these people moved out, sold it a year later, took the exclusion, 1031 to everything else, bought 24 different replacement properties, closed them all inside the 45 days, went from $1 million tax hit to 0. Very happy people. And it was a great transaction. Happy brokers, happy escrow. It was a great deal. This situation, this has nothing to do with 1031, but I just want to say, if you've got a transaction where, let's say the world goes upside down, and this is a guy that came to us, builder developer, had a piece of dirt, $1.2 million lien on it, $3 million property. And this was during the last crash. So the lender on that property, the bank was failing too. The bank goes away, the loan goes away, the property goes away. He didn't want to lose that. So he asked, can I use Dad's IRA to pay the property off? The answer is, if we look at the surface, no, you can't do that. But we found a way to do it. So we created a new limited liability company. Junior put the property and received a membership interest attributable to his equity in the property. At the same time that happened, we self-directed Dad's IRA, which shoved another $1.5 million or so into that LLC. Now the property had the LLC had the property. The LLC had the cash to pay the property off, which it did. At a later date, they ended up going vertical, building out the apartment complex that was owned by the LLC that had both Junior and Dad's IRA LLC as its members. So we went from a situation where the guy was going to lose the asset to a situation where now they have the money, they bought a property, got it all done, got them where they wanted to go. It's not all or nothing. These guys gave up a property, $3 million multifamily project, wanted $1 million property in the desert. They understood their tax basis was $250,000 on the $3 million property. They paid the tax on the $2 million in boot because they went from 3 to 1. And they still deferred the tax on the difference between the 250 and the million, still saving them $250,000 in tax. So at what point does an exchange no longer make sense? I don't know. It's really truly up to you. I think the smallest exchange I can remember doing in the 31 years now in business was like a $5,000 tax hit, and the exchange was costing $1,000. I wouldn't have done that, but this was a CPA that just insisted, hey, I don't want to pay any tax. So everybody's got a different pain threshold, and you've got to once again look at the gain on the disposition and what else is happening in your life. Can you offset the gains with losses? What are you comfortable paying? If you're doing something where you're converting assets, what's the cost? What's the opportunity cost that's there? What are you doing, over time that might be just sort of an incidental cost that comes up by doing the exchange. The exchange is not always the right thing to do. Don't do the transaction kicking the ball down the road when it's putting your life on hold, and that triggers other costs that are not something you want to deal with. Consideration. All right. So what is consideration? You look at your purchase sale agreement. You look at what it says. It doesn't say total cash paid for something. It's total consideration for consideration. And if you sell something, you say, well, gee, I can't take. Let's say I use a boat to buy a property. Well, the boat's not like kind. Well, you're taking cash for the sale. Cash isn't like kind. So anytime you're conveying anything, if you look at the purchase sale agreement, it says total consideration. Consideration could be anything. So in this situation, we're just looking at transaction. We're using, in this particular transaction, we might be using a note, we're using cash, we're using a property, and that's just that whole stack of capital that's being used to acquire a property. Now, in this particular transaction, the seller, the apartment building, didn't want that house. So if he was fine taking the house as consideration, but if we gave our client that house and then he sold it, he would have held it for resale. So what happened is the house came to us along with the cash and everything else, and then we ended up selling the house, converting it to cash. Just think about the page on the notes, what we do with the notes. All you're doing is whatever we're receiving, we've got to convert it and make it usable. So in this particular transaction, we had a note we had to convert. We had a building that we had to convert, and as I said, we couldn't give the building, the rental house to our seller, to our client, because he didn't want it. So we kept it, we sold it, then we had the cash to complete the transaction along with the note and everything else going forward. So, really, this is an example of taking the time to understand what's possible, planning in advance. Don't wait until everything's there, but really ask the questions. And this is an example of working with a good team of people to get where you want to go. Tick foreclosure, this is just phantom gain. So you remember the page on basis and gain. This is a tick that was a tenant institutional property that was being foreclosed. Taxpayer was going to lose everything, didn't realize that he was going to have a tremendous tax hit until his legal counsel, who had done a lot of work with us, alerted him to the fact. So basically, we ended up assigning ourselves in as the member of the LLC. Pre-foreclosure, that assignment triggered the beginning of the 45-180. Pretty simple question to ask. You want to pull money out of your pocket to pay taxes, or you want to pull less money out, honestly, to go buy something? So, in this situation, the answer was, hey, I'll pull some money out, go buy something. You look at, and in this situation, it was non-recourse debt, so the foreclosure was not going to impact the person's ability to go out and buy a new property. So we ended up, he just shows up at the purchase replacement property with the money required to buy it. Instead of losing the money, the federal and state tax, and potentially the healthcare tax, we're talking 35–40% tax hit. What kind of loan to value do you get on something? As I said, he ended up having to come out of pocket less money to go buy something than he would have had to if he's just paying the tax. So it's a pretty easy thing to have an answer to. And in this situation, we did the transaction, isolated him from the constructive receipt, in this case of debt relief, which would have triggered the phantom gain. This is an example of a combining 1031 money and qualified money being IRA 401k funds. So in the IRA 401k world, you can't transact between or for the benefit of a disqualified party, but you can transact along with a disqualified party. So if you want to be a co-owner of a project with your retirement account, that is entirely possible. You can't loan to or buy from. That would be a prohibited transaction, but you can transact along with, so you can be a co-owner of something. Now, understand there's two different ways to own property jointly with your retirement account. If you're looking at pulling money out of your pocket and using qualified money to buy something, it could be tenancy in common, or it could be as common members of a limited liability company. Now, 1031 specifically prohibits the exchange of partnership interests. So in this, anytime we're looking at combining planned money and 1031 money, we have to use tenancy in common. And in this case, we ultimately didn't do it because IRA 401k money, if it's a loan, it's got to be non-recourse debt. It's more expensive money. It's a lower loan to value. So we ended up doing it. We ended up self-directing this guy's accounts and ended up buying a bunch of other stuff, or he ended up buying it because we just provide the investment vehicle. But this just exhibits your ability to do it. And as I said, you've got the ability to combine planned money and personal money two ways, tenancy in common or as common members of an LLC. If we're using tenancy in common, you need to have a TIC agreement that spells out the operation of that property. You got questions on this, please give us a call. It's complicated, but you've got a place to get answers. This is a transaction where we do, as I said at the top, a lot of entity creation in here. And so this is a transaction where we had a good friend broker that had picked up a piece of property, and one of his clients, we had a big transaction. He'd given up some multifamily properties, had a chunk of capital that he needed to place. And so the broker that had owned the dirt had gone forward and had started into the development of this property. Now, it hadn't gotten shovel in the ground, but as far as planning, engineering, permitting, all that stuff, he was well along the way. He ultimately wanted to be a partner of our client, the 1031 client in this project. So what happened is the broker ended up selling to our client on a note and trust deed. And that allowed our client to keep more of his capital intact. We bought the property. We then started going vertical on the property. And as the project progressed, we satisfied our client's 1031 needs through an improvement exchange project. And then we conveyed the property to our client, completing the transaction. The note was still in play between the taxpayer, our exchanger, and that broker. And a year later, what would happen is that note became a convertible note, and our client ended up, we created another limited liability company. Our client contributed his property to the new limited liability company. The note was then converted into a membership interest into the LLC, and now the broker's a partner in that project along with our client. There was no tax consequence of a sale for the broker, and there was no tax consequence on the conversion of the note into that project. So I just think that that's a great example of a project that came to us and really had no idea of how they were going to get there, but using a couple different vehicles, a couple different instruments, and taking the time to plan it out, working with good tax and legal people, we got the deal done. This has nothing to do with 1031, all right? It's just an example of what's possible with a retirement account. This is the last example. And sorry if you've been to the classes before, but I just love it. Older couple comes to us, retirement accounts, they are retired, and they want to take their retirement accounts, go buy a mobile home RV park, and we start talking to them about something called a Checkbook Ira, which in a nutshell means that we're going to take both his and her retirement accounts, create a limited liability company. The retirement accounts are the members, actually the trust company for benefit each of the retirement accounts, the members of the LLC, and the LLC would then go buy the park. Then they said, well, gee, we want to be the on-site managers, and we want to be compensated for working there. Well, all of that would constitute prohibited transactions, blow up the IRAs. So we ended up shifting gears into something called a rollover business startup, which, by the way, in recessionary times, we do a lot of. But anyway, so what we ended up doing is going from IRAs and an LLC to a 401k plan and C corporation, and it has to be the structure. I know you're going to come back and you say, David, you said never own property in a C corp. Well, this is a situation where we have to. So we took his and her retirement accounts, rolled them into the 401k plan, created a C corp. The plan bought the corp bought the park. They got an investment, they got a job, and they got a place to live, all with this one deal. And I really love that solution. So anything's possible given time and planning. These are a couple places you can find us: IRAadvantage.com, self-directed retirement accounts, post 1031. If you've got something, you're looking for something, or you're a broker and you got property you might not even have control of, you can throw it up there and gets it in front of people. 1031exchange.com is how you found us. Please take a look at the social media stuff. And our YouTube channel, like I said earlier, has got information on all different aspects of the exchanges and stuff that has nothing to do with exchanging too. I've got videos up there on life insurance contracts. So let's say you're getting older and you've got a situation where maybe you've got a life insurance contract or policies that you no longer need. Well, instead of just letting them lapse, maybe you sell that thing. So life policies are even something of value. There's a series on that on our YouTube channel. Charitable remainder trusts are on there. Rent control videos are on there. Cost segregation is on there. All of these things. And if you've got an idea for a topic that you would like to see us put something together on, please don't hesitate to reach out to us. You can reach us at cmoore, C-M-O-O-R-E, at 1031exchange.com. By the way, if you're in Oregon, you are entitled to an hour of CE for this presentation today. And I just want to thank you once again for taking the time out of your busy day to share with us today. I apologize we went long. Obviously, if I want to keep this at an hour, I'm going to have to trim some information. Hope you found it helpful, and I look forward to talking with you soon. All my best, David Moore, Equity Advantage, and look forward to talking with you soon. Take care. Bye-bye.